This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation. Our goal is to encourage accuracy and accountability to help smaller nonprofits successfully manage and sustain their organizations.
Hi, I'm Ben Takis, founding attorney at Tax Exempt Solutions, and in this webinar we'll provide an overview of fiscal sponsorship. Fiscal sponsorship is a very important tool for getting funding to new organizations and charitable activities. So in this webinar we'll talk about what fiscal sponsorship is and how to do it right. First, what is fiscal sponsorship? Fiscal sponsorship is not a legally defined term, and it can take many forms. Generally, it can encompass any relationship in which an existing 501c3 public charity provides support for a new charitable activity. However, most commonly we have a specific relationship in mind, in which a 501c3 public charity agrees to receive grant funds or donations on behalf of an independent project and disperse the funds in support of the project, subject to the charity's oversight, discretion, and control. When fiscal sponsorship is done right, it offers benefits to everybody involved. First of all, individual donors. Donors can give a donation to support the project and get a charitable deduction for the donation because it's going through a 501c3 fiscal sponsor. If donors were to give directly to the project that doesn't have 501c3 status, it would not qualify for the charitable deduction. Second, private foundations can give to the project and they don't have to exercise what's called expenditure responsibility over the grant. Normally, if foundations were to make a grant directly to a project that is not a 501c3, they'd have to exercise oversight to make sure all the activities are consistent with a 501c3 mission. With fiscal sponsorship, private foundations can make those grants without those responsibilities, and they're much more likely to make grants as a result. The project, like I said, fiscal sponsorship allows a project to get started fundraising quickly and not go through the very time-consuming and expensive process of applying for 501c3 status. This was particularly important a few years ago when it was taking the IRS a very long time to process new applications. So fiscal sponsorship allows new projects to get started fundraising right away. And lastly, the fiscal sponsor can get a benefit as well. Sponsors will typically charge a percentage fee for the administrative burden of overseeing the grant, and that's a source of revenue for the sponsor. Typically, they'll charge anywhere between 5 and 15%, although this can vary depending on what kind of services and help the sponsor is offering. This can vary depending on the services or help that the sponsor is offering. Lastly, I'll say that the public gets a benefit from fiscal sponsorship as well. The public gets the benefit of new charitable activities and experimentation within the nonprofit sector without having a bunch of new organizations out competing for funds and duplicating the very expensive administrative costs of running an organization. Fiscal sponsorship can be a very helpful and valuable tool, but unfortunately the specifics of the relationship are widely misunderstood. One illustration of this is by the frequent and incorrect use of the term fiscal agency. This is a term you'll hear a lot to describe what should be called fiscal sponsorship, but it's not really accurate. And here's why. The tax benefits of fiscal sponsorship require the sponsor to exercise oversight, discretion, and control over the money. By definition, a fiscal agent does not exercise control. The fiscal agent is just receiving money, passing along with no real role in the project. So when you use the term fiscal agency to describe fiscal sponsorship, it's kind of misleading and implies that things are not being done correctly. When fiscal sponsorship is done the right way, here's how it looks. This is the most common way that fiscal sponsorships are set up. This is sometimes called the Model C or pre-approved grant relationship. So under this relationship, The project will approach a donor or grantor and solicit funds for the project. The donor or grantor will pay the funds to the fiscal sponsor, and the sponsor will disperse the funds to the project, subject to the sponsor's control and discretion. In exchange for this, the project will be required to provide periodic reports to the sponsor detailing the status of the project and how the money was being used. So this is how you do it the right way. When fiscal sponsorship is set up the wrong way, usually looks something like this. You have a donor or a grantor paying funds to the sponsor, but those funds are earmarked for the project. An earmark is an implicit or explicit agreement that the funds ultimately will be transferred to a specific party other than the initial recipient. And in this scenario, the sponsor really has no role, no control and discretion over the funds. They're really just receiving the funds, passing them along to the project. So what's wrong with this? If the Internal Revenue Service determines that funds are earmarked for a party that is not a 501c3 organization formed in the United States, the funds will be treated as being paid directly to that party. So the IRS will ignore this in-between step of paying money to a sponsor that had no real role in the project. The consequences are that first, individual donations to the project will not be eligible for the charitable deduction, and private foundations will likely have to exercise expenditure responsibility over the grant. And as a practical matter, this usually means that foundations will be unwilling to make the grant in the first place. The bottom line, as I've said, the sponsor has to exercise oversight, control, and discretion over the project funds. And we'll talk about how to set that up and do it right. To establish the sponsor's oversight, discretion, and control, you should follow these guidelines. First, the sponsor and the project should execute a fiscal sponsorship agreement detailing the rights and responsibilities of both parties. This should be executed and set up before the project goes soliciting grants. Second, as part of this fiscal sponsorship agreement, the ultimate decision whether to disperse funds to the project and the particular amounts dispersed must remain within the discretion of the fiscal sponsor. This is called the variance power. In most cases, the sponsor will indeed disperse the funds as expected, but it's important to give the sponsor the ultimate authority about whether it's proper to disperse the funds. Also, typically in the fiscal sponsorship agreement, you'll see some restrictions about the use of the funds. A project should not be using the funds dispersed from the sponsor for political activities and other purposes not consistent with a 501c3, because in this relationship, the sponsor has ultimate responsibility for how the money is spent. So the money can't be spent in a way that's not consistent with the sponsor's tax-exempt status. Lastly, again, as detailed in the fiscal sponsorship agreement, the project will have to provide periodic reports to the sponsor to assure the sponsor that all project expenditures are consistent with 501c3 purposes. And there's some precedent, an IRS revenue ruling, and a case that set forth some of these guidelines. First, before we conclude, a note to project leaders. Under the Model C relationship, the project is a separate legal entity distinct from the sponsor. So this means, regardless of whether the project has incorporated or formed an LLC, the project is a legal entity that is responsible for filing tax returns on behalf of the project, so reporting it as taxable income, paying appropriate taxes, including employment taxes for employees who work on the project, and paying for the project's other debts, liabilities, and legal obligations. If this burden is too much, the project could consider carrying out the activity directly in the name of the sponsor. So in this situation, the project would become part of the sponsor, and the people working on the activities would be employees or volunteers of the sponsor. This is sometimes called the Model A or direct project relationship, and could be appropriate for some circumstances. But this webinar, we're talking about the Model C relationship, where there is a separate independent project working in conjunction with a 501c3 fiscal sponsor. If you decide that Model C relationship does work for the project, here are the 7 legal steps to carry that out. And this is taken from a book by Gregory Colvin called Fiscal Sponsorship: 6 Ways to Do It Right. It's a very important book in the field, which formalized all these elements of a proper fiscal sponsorship relationship. So in step 1, some of this will be review, but step 1, the project submits a sponsorship proposal to the sponsor. Step 2, the sponsor evaluates the proposal to determine whether the project is consistent with the sponsor's mission and 501c3 status. The board of directors of the sponsor should then consider whether they want to approve the relationship. And assuming that gets approved, the sponsor and the project will execute a written fiscal sponsorship agreement detailing the sponsor's oversight, control, and discretion over the grant funds. Step 5, the project will then go out soliciting grants and donations, letting funders know that any grant agreements will be between the donor and the sponsor. Step 6, funds will get paid to the sponsor and dispersed from the sponsor to the project, subject to the terms of the fiscal sponsorship agreement. And lastly, as I mentioned, the project will provide periodic written reports to the sponsor detailing how the money is being spent and the status of the project. So that is an overview of fiscal sponsorship and how to do it right. Thanks and good luck.